As the stock market becomes more and more expensive and it becomes increasingly difficult to find stocks for decent valuations, we can turn towards these super investors who just released their filings, their quarterly filings, which show us which stocks they are buying, where they are looking for value, and what piques their interest. Now, when we look at these super investors, we can see on Dataroma, we can see their US portfolios, and we can see that they manage anywhere between, well, by and large, a couple $100 million to a few to tens of billions of dollars. So in this video, we will be looking at the Sequoia Fund, a fund that was created by William Ruane and Richard Cunniff in 1970. And the unique thing about this fund is that it was built on the clients of Warren Buffett after he closed his partnership in 1969. And well, Warren Buffett sent them towards this fund all the way, well, more than 50 years ago now. So, since the inception in 1970, this fund, the Sequoia Fund at least, has seen one of the best performances, is one of the best performing funds out there in the market. We will also look at Christopher Bloomstrand, a value-driven investor who has a lot of material online through podcasts and a very heavy focus on Berkshire Hathaway, but also an investor that has been making some very interesting investments in the latest quarter. Now, then we have Bill Ackman from Pershing Square Capital Management, a very vocal and active portfolio manager on social media. He has made some interesting moves regarding some of the positions he has taken. So we will zoom into these positions slightly to determine what we think of it and how interesting or credible they are. I also want to go through Valley Forge Capital Management, a fund with $4.5 billion of assets under management right now, and it's only in 8 stocks. It's incredibly concentrated, so we will be taking a look at the moves that has been happening in this fund, because with only 8 stocks, it can't be that much, right? Now, the last investor I want to look at is Guy Spear of the Aquamarine Fund. And he is a Zurich-based investor, also very focused on value and someone that shares a lot of wisdom through YouTube videos and joining podcasts. A very interesting person, in my opinion, with a very admirable investment philosophy. So we will take a look at what he has been doing, because what he has done this quarter is what I see as peak investing. Now, at the end, after going through these portfolios and the changes they have made in the last 3 months, we will pick out 2 or 3 stocks maybe, which we want to zoom in on, see what they do, dive a bit into the fundamentals to see if this might be interesting buys like these super investors are doing. Now, all in all, I think this should be a very interesting video, and well, let's just start right at the beginning. Now, just quickly in between. This is kind of a new thing I do or try to do and see if you guys like it. Highlighting some of the super investor portfolios, what the big investors are doing, and seeing if we can pick up some things from it. Highlight some of the stocks, and at the end I will check what the super investors are doing with my stocks. Now, if this is something you like, please make sure to subscribe to my channel, give this video a thumbs up, and let me know in the comments down below. Now, let's quickly continue. And what we want to start with is by looking at that Sequoia Fund. Now, we can see that they have about $3.5 billion of portfolio value. And what we can see is that they reduced their position in Google by about 4.5%. They reduced their position in Charles Schwab by about 6.5%. They added to the Universal Music Group by 2%. And the Credit Acceptance Corp, I've never heard of them in all honesty, they reduced their position by 9%. Now, if we scroll down somewhat more, we can see some more. We can see that they reduced CarMax by 55% and that they bought into Amentum Holdings, which is a new buy for them, but it's only consisting of 0.9% of the portfolio, so it's not all that impressive or meaningful whatsoever. Now, this is also slightly better visualized if we look at the activity per quarter, and we can see that this quarter, once again, the add to the Universal Music Group, a buy into Amentum Holdings, but we can see that overall they are not doing all that much. I mean, last quarter they bought into Charter Communications for 1.5% of their portfolio, and overall, if we scroll down, we have to admit, most of what they do is selling. They don't buy all that much. Here in Q3 2023, they bought a little bit, but all in all, I think they predominantly are selling off their assets, which is kind of a shame. I do think most of their portfolio is quite strong, but they are not being all that active right now. Then we get to Christopher Bloomstrand, an investor who has almost $600 million in portfolio value. And these are their US listed stocks, right? So if he would have, and I don't know if he has, but if he were to have stocks in Europe, for example, they will not show up here. Now, what we can see is that he's very focused into Berkshire Hathaway. I mean, if we just add this up, this is almost 33%. Almost a third of his portfolio is just in Berkshire Hathaway. He's also very focused into Dollar General. And I mean, Kinross Gold Corp is also quite strongly weighted, especially for a fourth position for these investors. So I do kind of like that. But what this also means is that when we go down, we can see a bunch of stocks which basically have no weighting whatsoever. I mean, a 0.04% weighting for example, Amazon as a new buy, it's not going to really move the needle whatsoever, right? I mean, also here, American Express at 0.2%, Coca-Cola at 0.27%. I think this is overweighting these positions even more so than they already are at Berkshire Hathaway. That's my best guess, because otherwise I wouldn't really know as to why you will buy them in such a small quantity. Now we also see Costco, a company that's for a value investor a really strong buy, really goes into their Charlie Munger mindset. And overall, I think this is a very strong portfolio. And if we go more so towards the activity, we can see that he has been doing a lot of buying. He added almost 400% to Dollar Tree, 200% to Valero Energy, almost 100% to both Dollar General and HF Sinclair Corp. So he has been buying a lot of companies. If we look at his reductions and his sells, we can see that he took profits in Phillips 66, Microchip Technology. He sold out of Google, which is quite interesting in my opinion because it's very low valued, and Washington Federal. Now we see Mercury General Corp and Apple being big sells, but that's about it. Overall, like I said, I think a lot of action within this portfolio, but more so adding to companies instead of buying entirely new companies, because we can see that only the Gold Mini Share Trust and Amazon were new buys in this portfolio. Then we have Bill Ackman of Pershing Square Capital. I mean, a very, like I said in the intro already, a very vocal investor, very interesting to follow on Twitter. I mean, he posts about a bunch of issues, even stock market related, but also politically related. It's quite entertaining to look at. Now he has a portfolio value of almost $13 billion, and he holds about 10 stocks. So, or he owns a few more, but 10 US listed stocks. Now he has been adding a lot to Brookfield. He has been adding a lot to Nike, a buy which originally, I think it was presumed in the market that he was going to just flip it quickly in the latest stock drop. However, it has now become an 11% weighting within his portfolio. So overall, I think that is quite a bit. Maybe there is more to this position than originally thought. Now we can also see that he added Seaport Entertainment Group. A very interesting holding, because when we look at this company, we can see that it has only a $400 million market cap. So Bill Ackman is one of the very large holders within this company. And we can see that right here, because he owns almost 38% of the market cap, which is a staggering amount. He is a massive investor within this company. But what is it? Well, when we go back to his portfolio, we can see another company here right above Nike, the Howard Hughes Holdings. And Seaport Entertainment Group is a spin-off from that company. They own a bunch of stakes in restaurants, some sports teams they hold. So overall, I think it's a really interesting company. I might look somewhat into it because I quite like Bill Ackman. He's very controversial, but he's kind of annoying to many people while being quite of a genius. I kind of like that, I have to be honest there. So I will be looking into Seaport Entertainment Group. It's a very small company, but I will see what I think of it. Now that will not happen in this video, but I might make a future video about it. Now, what we can then see is Valley Forge Capital Management, the portfolio with 8 stocks and $4.5 billion of portfolio value. So once again, highly concentrated. And what we can see is that most of it is concentrated into FICO, Fair Isaac Corp. But they also own, or they have a portfolio weighting for almost 20% in S&P Global, 16% in MasterCard, 14 or 13.5% of Moody's. Now, they haven't done all that much. And if we look at what has been happening at Valley Forge Capital this year, we can see that basically only this quarter they started buying, and they almost doubled their position in ASML, a company that I want to look at more closely as well, as it has been selling off quite impressively. They have been buying Moody's and they have been buying S&P Global. Now we can see that in Q1, Q2 and Q3 they have been slightly trimming FICO, Fair Isaac. However, by far not as much as the company has been going up, right? So whatever this is, it's not that much. It's a shame that he trimmed almost 7.8% of FICO, but in order to buy or to double that ASML position, you have to get the money from somewhere, right? That means that right now we only have Guy Spear left. And what we can see is that he owns 22.6% or 22.6% of his portfolio is in Berkshire Hathaway. We can see almost 19.95% in American Express, 11% in MasterCard, 10% in Bank of America, 9.8% in Ferrari, which is really interesting. And we see furthermore more Berkshire Hathaway, Micron, Moody's, Daily Journal, Alibaba, Alphabet. When we go to his activity, and this is why I say that he is a quintessential, the perfect, or not the perfect, but a really strong investor in my opinion. He has done absolutely nothing. Nothing happened. He bought 2 companies in Q2 of 2024 and he sold 25% of Ferrari in Q1 of 2024. Now, I think Ferrari shares, he got them from the split off of Fiat when they split it. So, I mean, he has been holding that position for a very long time. Now, the only quarter something else happened was Q2 of 2022. That was the latest piece of action. So almost nothing happened for 2 years. And he decided to trim one position, which he has held for, I think, since 2016 by 25%. That's it. I mean, he buys into companies and he just holds them. There's nothing happening. And I quite admire that because that is really, really difficult to do. That is not something that comes easy. Now, if we then look at the companies that were bought in this latest quarter, basically we see 3 companies that I have no affiliation with whatsoever. Consol Energy, Chart Industries, Flutter Entertainment. Never heard of them. But we can also see Visa. Now, Visa is a company that I of course have heard of before. And what we can see is that in the latest period, the stock has gone up quite a bit. From about the 260 level right here, up to almost 300 or slightly over $300. So that is very good. And we can see right here the ownership, and we can also see the activity, because what we can see is that in the latest quarter, Q3 2024, we can see that there were 3 new buys of this company and a bunch of sales. Now, these are only small, but adding to it by 20%, 35% and 45%, I think is quite a bit. But 85%, I mean, that's a lot, right, to add to a position. Now, we can also see that some companies sold it. So we can see Terry Smith from Fundsmith, also a very good investor who has made some questionable decisions lately or over the last few years. He reduced it by 0.1%. We can see right here, also another 1%, 2.5%, 3%, 6%. Only this one and Altarock made really, really impressive sales of the business at 37% and 53%. And this also consists of over 3% of their portfolio. So that is more impressive as a sale for this company. Now, if we then do an initial dive into the fundamentals of Visa, we can see that it is trading at a 31.9 times last 12-month PE ratio, just the normal PE ratio, and a 27.7 forward PE ratio. Now, from the initial charts, this doesn't look all that low, but it also doesn't look really high. But we will look at it into more detail in a bit. But first, let's go through this, right? Because we see also a market cap of 600 billion. It is a really, really big company, Visa. Now we can see total debt of 21.8 billion, quite stable here, and cash of 15 billion. Now this has been coming down slightly. Now for Visa, what the expectation is revenue growth of 9%, 10% and 9.5%, and EPS growth of 11.5%, 12.9% and 13.9%. So it is not one of the very fast growers, but it is a really stable business. Now, what I do find really interesting, however, is that we can see that compared to the S&P 500, compared to the SPY, we can see an outperformance, or an underperformance, I should say, of about 29% over the past 5 years, from November 21st, 2019 to November 25th, 2024. Over the past 5 years, Visa has underperformed the S&P 500, something I didn't really expect from this business. Now, this means in terms of total return, so including dividends, Visa returned 78.5% to investors over the past 5 years. But remember, this is with or including dividends. If we exclude the dividends, we come to 72.3%. Now that is slightly lower, of course. However, the dividends do add slightly, so 70.3% or 72.3% and 78.5%. Now, when we look at the forward PE, the next 12-month PE, we can already see why we have the underperformance, because we have this peak right here over the last 5 years. So when we look at it, the company was trading high and well into the, well, very high into the next 12-month forward PE ratios of towards 40. And this has been normalizing somewhat towards 27 now. And if we look at it on a 10-year basis, we can also see that this peak right here, it's just a massive peak, right? And over the last 10 years, the company isn't trading all that rich. So overall, this is something, or a buy, that I quite like. Not something that I might look into for myself, but it is, I think, a very quality buy. And talking about that forward PE just one more time, we can see that right here, that over the last 10 years, Visa has outperformed the S&P 500 by 180%. So over the last 10 years, with that bump right here towards the high valuations, the incredibly almost 40 forward PE, we can see that the company did outperform the S&P 500 at a massive amount. But since that bubble right there, the high PE ratio been going down, the share price has stayed quite flat, and therefore the S&P 500 managed to catch up a bit. Now, another factor that might make Visa very attractive is the overall increases we see in dividends. Because right here in 2022, we see it being 38 cents. They then bumped it to 45%, then increased it to 52 cents, and now it's 59 cents. So they are increasing their EPS, or their dividends, I should say, very, very rapidly. And that's of course also very interesting when you're looking to buy a somewhat more value type or mature company. You look for that increasing dividends. Now, like I just said, although this may not be a company that I am specifically looking at to buy, it is a very good business, a very good stock, and I do absolutely see why people would buy into it. Now, there are two more stocks I want to look at. And the first of these two stocks is Dollar General. Because we can see from Dollar General that share price going down massively. What we can also see slightly to the left of it is the insider buys and sales over the last 6 months. And we can see that there were 3 insider buys and 2 insider sales. So overall, we can see that although the amount is smaller, we have an insider buying into this business. Now, what we can also see is that Christopher Bloomstrand, which we just looked at, he added 95% to this position. We can see Seth Klarman buying into the company, And then we see 2 more people buying into it. Now, in contrast, over the last quarter, we saw no major super investors selling this stock. But that might also be because everyone who wanted to sell out has sold out by now. So let's look at Dollar General for a second. And what we can immediately see is that since 2022, this is 2022, so 2023 around here, this stock has been selling off massively, right? Over the last month, it's down 7.5%. Over the last 3 months, it's down 40%. Year to date, it's down 45%. And over the 1 year, it's down 40%. We can see that also right here. It's just been in a nasty, nasty downtrend. Now, what else can we see? We have a trailing PE ratio. So a PE ratio of 11.7, which is extremely low. We see a forward PE of 12.5, which once again is also extremely low. So I get why people are buying it with an eye on value, right? We have a market cap right now of 16.5 billion, which has been coming down quite a bit as well. Total debt of 18 billion and total cash of 1.2 billion. So they are raising their cash amounts here, is what we can see. But I mean, company has quite a difficult time, right? We can see that the expected revenues are 40 billion, 42.5 billion, and 44.6 billion, or for a growth of 4.7 and 5% in terms of sales. However, we can also see that EPS is expected to go down by 22.5% this year and only increase by 6% and 11% in the 2 years thereafter. So overall, that picture for Dollar General is not really all that well. And if you buy this, you buy it on a bet that this company will turn around its fate and will start going up again. And so, like I did with Visa, let's look at the relative performance to the SPY, the S&P 500, over the last 5 years, I should start with. And we can see an underperformance of 157%, which is incredibly bad, But then we also saw what happened to the share price, right? Now, it has been trading about 40 or 35% as outperforming the S&P 500. And over the past 10 years, it has actually done very well. We have been, or this company has been, at almost 200% of outperformance of the S&P 500. However, right now, over the past 10 years, it's down more than 200% compared to the S&P 500. So that's not really ideal. We can see the swing right here. It's quite incredible. Things become even more sad when we look at the 10-year performance of Dollar General, because right now, over the last 10 years, if you were to have held this stock over the last 10 years, you were up on the share price a staggering 11%. That is really bad. That's really bad. We can see that the stock has been up as much as 280 to 290%. And I mean, when we look at the total return, it is not quite as bad as the stock return, because we see 24.5%. But even 24.5% returns over 10 years, that's incredibly bad for a stock. And lots of it came from those recent issues. But imagine you bought the stock 10 years ago and you were looking at it right now and you were up 24%. How disappointing would that be? Now, the total returns have been well over 300% for this business, and it has seen massive outperformance of the S&P 500, just not in the last 2 years. That's quite safe to say, I think. Now, what we can also see is that the issue isn't so much the revenues, because these are the quarterly revenues, and we can see that apart from this quarter right here, Q1 2023, the revenues are at an all-time high. So we can see this steady uptrend right here. The steady uptrend in revenues, kind of maybe sort of flatlining since this point. But overall, they look really good. So it's not that the revenue is the issue. Now, what is the issue, however, is the net margins. Because if we look at this net margin profile, we can see that they went from 9%, but this was during the COVID bubble, I think. So let's take a normalized 6.9% over the past 10 years, or even over the past 20 years, 4.8%. But over the last 10 years, it was 6.1%. We are now at 3.66%. So the margins are shrinking quite rapidly. and by a very, very large extent. And due to this decreasing margins, we can even look at their shares outstanding. And we can see that they have been very active with buying down the total share amount. They have been doing a lot of buybacks. But even at the current valuation, at an 11 forward PE, 12 forward PE, something like that, they have not been managing to buy back their shares because there is just, presumably, I assume, there is no money left for doing those buybacks that you want to be doing very, very heavily right now. Now, what we can see, however, is that right now the trailing free cash flow, the trailing 12-month, the last 12-month free cash flow, is starting to look really good. Because over the past 10 years, I would say that this is also about the average where they are right now. So that free cash flow metric is looking a bit better than the margins and the share repurchases. Now, this increased free cash flow also made or contributed to this absolutely exploding free cash flow yield. Because we can see that right now the free cash flow yield is at about 10%, right? Because we saw that 1.6 billion in free cash flow and a $16 billion market cap. Now, a 10% free cash flow yield, that's quite incredible. So maybe Dollar General should be on my list to dive into to see what the actual issues are, because I know vaguely, I think someone mentioned somewhere the competition from China, but I might want to look into this one. I think that overall the margins for Dollar General, they show real issues, right? They show really big issues. We do have a dividend yield right now of 3.15%. However, we should be looking at the payout ratio to see how sustainable this is, with the margins going down as much as they do. So the extremely low valuation on a PE metric at 12.5, that does provide some opportunities. That does make this an interesting stock. However, be careful if you want to just dive straight into it because of this valuation, because the company has issues, right? And I might dive into what those exactly are, but we can certainly say that they have issues. Now, at the very end, I want to look at what investors did with my holdings. But first, let's look at what the overall, the overarching idea was here, because we can see the latest quarter sales. And this goes by the percentage of the overall super investor portfolio, right? So we see Microsoft about 0.3% of the overall super investor portfolio sold Microsoft, but you have to rationalize this a bit, right? Because Microsoft is super big. We can also see that there was 16 super investors selling this business. So there was a lot of action happening within Microsoft, but what we can also see is Arch Resources, something I'm not too familiar with. We see Meta and Amazon as well as Apple. So overall, from the Magnificent Seven, we can already see that 4 of those are in the biggest seller list. Now, if we then go down a bit more, we can see, for example, Fair Isaac, but I think this is due to the selling mainly from Valley Forge Capital, which I showed you. What other interesting things are here? Number 5 of the Magnificent Seven, Alphabet, we can see being sold off quite a bit. Now, Visa, which I just highlighted as being one of the most bought, is also one of the more so sold. We can see Brookfield, which has been on an incredible run by 2 super investors being sold, and also in this list right here. And that makes up, I think, about most of it. Now, this is really interesting because it shows you what super investors are thinking right here. But let's just see what happened with the portfolios of super investors for my holdings. And to give a proper idea of what's been happening, this lowest line is S&P Global. You can not quite see it because it's right behind me. Then we have Adobe at a 4% weighting, Shopify at a 5.2%. Then we jump towards Celsius at 7.9% weighting right now. Monday at 8, Elf at 8.7, SoFi now at 9.3. Remember, I have been trimming this position slightly because the stock has been on such an incredible run, which to me sounds unsustainable. However, I don't want to sell out of it because I do really like the company. So I've been taking it down slightly, not really looking to have a financial institution at a 15% weighting when I see some issues within the markets. Now, we have Kering at 10.7, Lululemon at 13.4, and PayPal at 27.45%. And when we start simply at the very top, we can see an ownership count of 9 and an ownership rank of 29, which is, I think, quite high, especially for when you see how many bigger companies there are out there. And if we go down slightly, we can start seeing the holders. And what we can then see is that Pat Dorsey, the inventor of the moat rating by Morningstar, he holds this at a almost 10% weighting, and he trimmed it slightly by 2.8%. Now, such small trims more so suggest redemptions to investors over actually selling this company, right? So we can see the same with Linsell Train at an 8% weighting and David Rolfe at Wedgwood Partners at 7.85% of their portfolios. Now we can then see Mason Hawkins and Harry Byrne buying into the businesses at 2.7 and 3.8%, but we can see David Katz and Poland Capital selling out of it slightly. We can see Lee Ainsley really adding to it quite a bit, by about 180%, but it's only a 0.05% weighting. So nothing meaningful. But overall, we can see a good transformation within PayPal right here. There is more buying than there is selling. Now, as for Lululemon, we can see there were 2 buys. Also, there are only 2 owners of this business. And overall, we can also see, which I wasn't quite aware of in the latest quarter, we can see 2 or 1 insider buy and 1 insider sell, but a buy of over $1 million, which is quite interesting in my opinion. Now, when we then look at SoFi, because I couldn't show Kering because of course it's not US listed, it's a French company, it's listed in France. But with SoFi, we can see 2 insider buys totaling 400,000 and 7 insider sales, which total slightly more, quite a bit more. Now we can see that there is 1 person buying it, and that is Samantha McElmore. And for her, it's about 2% of her portfolio. She added 50% to it. So overall, I don't think that's looking all too bad, right? But we can also see right here, if I go right here, we can see the insider buys and sales. And we can see, well, this person only being selling all the way from June, which are not the best sales, of course. But we can see Anthony Noto, the person that really matters. He has been purchasing the stock quite a bit. He has been really active with buying this company with his own money. And I think that gives a great look for the business. Now, then for ELF, one you might really like, we can see that they have 1 company buying into the stock. Poland Capital with about almost $7 million. So that's quite a big investment, I think, within this portfolio. But we can see from the insiders 110 sales over the last 6 months, totaling $51 million, which is quite excessive. Not the best look, not the most perfect look. However, the company has been going up quite a bit. Over the last 6 months, it hasn't. So maybe they were just trying to cash out quickly before the stock would decrease even more so, fulfilling tax obligations. But there has been quite a bit of selling from insiders in this business. This makes it look as if they don't know how quickly to abandon ship, right? Now, then one last company, which I think is quite interesting. Not so much because it's a very big holding of mine, but more so because it has seen its fair share of difficulties within the share price. And that is Adobe. And when we look at Adobe, we can see that an ownership count of 9 and an ownership rank of 29th, right? So that is quite interesting in and of itself. We can see 25 insider sales totaling 37 million And when we look at the activity happening within the holders, and let's look at it this way, we can see that Poland Capital has been adding to it by 25%. And overall, we can only see one person selling out of it for 100%, but he owned 888 shares and it was for 0.01% of his portfolio. Now we can see David Tepper selling it by 44% or selling the position down by 44% or about 1.2% of his portfolio. So overall, I would say that for Adobe, the actions or the activity is about even. Now we can go with it slightly lower over the last quarters, because here we can see that over the last quarters where the share price was kind of similar, we can certainly see that there was a lot more buying into this company, and especially in Q1 2024, than there was selling. Now this happened at about an equal share price as to where the business is now. So overall, this is also one of the companies that I'm looking for in order to buy a bit more of. Adobe, it's one of those more defensive type, mature type businesses, which I really like. Now, if you like what I did here with highlighting some of the super investors that I like, that I try to follow a bit, highlight to stocks that have been bought a lot by super investors, then surely give it a thumbs up, make sure to subscribe to my channel and let me know if I should do more of these types of videos. But with that being said, thank you for watching this video and I hope to see you in my next one.